Hi, it's Jack Fournier at Beacon Wealth Partners, and it's July of 2024. Travis Kidson and I have recently updated the accounts, the portfolios for you. And before Travis comes on and talks about the changes we've made inside the different parts, I wanted to give you a bit of an overview of how we look at your portfolios and a bit of a historical context to why we've made some changes. Conceptually, we look at your portfolio as having four parts. We call them sleeves. The first is a fixed income component, giving you access to government debt and corporate debt. Effectively, you've lent money to governments and corporations, and you get paid an income stream for this. The second is a core equity sleeve, giving you exposure to the companies that are the backbone of our economies, so things like Johnson & Johnson, Royal Bank, and Nestle. You also get paid a dividend from this part of the portfolio. The third sleeve gives you access to what we call alternatives. Real assets, so real estate, infrastructure, commodities, and also private debt. Here too pays a dividend. And then the fourth and the largest component is the tactical equity sleeve. Here we're trying to align the investment choices with what's working in the market, where the economy is growing. So lately that's been technology, so we maintain a very good exposure to technology in this part of the portfolio. And now for a bit of historical context. So if we go back to 2008, the Great Recession, central banks were very concerned about economic growth stopping, and they lowered interest rates to zero. Fast forward a number of years, so in the mid-2015 going forward, we started to see interest rates coming up some. And then, of course, we had COVID in 2020, and interest rates were again lowered to zero. We had kept the fixed income part of the portfolio fairly low during this period because when interest rates are zero, they have one direction to go, which is up. And when interest rates rise, the prices of fixed income assets fall. So we were trying to protect the portfolio. As well, you were not getting paid an awful lot of income for holding those assets. Come 2022, inflation's very high. Central banks have waited to raise interest rates, concerned about the strength of the economy, and then they decide to raise rates dramatically in 2022. Interest rates went from 0 to 5.25%. This drove fixed income prices down. It drove money out of the equity markets as people were concerned about how well companies could run their business in this higher interest rate environment. And that turned out, of course, not to be an issue. The companies continued to grow, but in the meantime, money moved out of the equity markets. By the end of 2022, it was fairly apparent that interest rate hikes had probably stopped. So at the beginning of 2023, we increased the money in the fixed income part of the portfolio for you. Now, since then, of course, the last 18 months, we've seen equity markets have very strong returns, especially the technology part. So as a consequence of that, even though we'd raised the amount of money in the fixed income, it's fallen back down as a percentage of the overall portfolio. So we've moved money from the tactical equity sleeve into the other three components of the portfolio. And now Travis is going to give you an overview of what we've done in those three different parts. Thank you.
Thanks, Jack. Hello, everyone. I'm Travis. Hopefully you've been able to enjoy the sunny weather with your friends and family. Today, I just really wanted to continue from where Jack left off and just elaborate a bit more on the changes that we made on your portfolio. So as interest rates have now peaked and appear to be slowly on the way down, one of the things that we wanted to do is ensure that your portfolio was positioned to benefit from this economic shift that we're expecting to take place over the next 18 months. Each sleeve or section of your portfolio is designed to behave differently compared to the other. And our hope is that this will help smooth out your returns over time. And so as interest rates start to fall, we felt that there were two parts of your portfolio that we could change to help benefit from this circumstance. So the first area was your fixed income sleeve. And what will happen is as interest rates fall, what we tend to see is fixed income prices rising. And the reason for that is the older fixed income investments that your portfolio will have will contain an investment that has a higher yield relative to new investments that come on the market, because those new investments will now see an interest rate that is reflected of the lower ones that the market is currently generating. Secondly, we've also increased your real asset sleeve of your portfolio. Primarily, we've increased exposure into real estate. And the reason for that is similar. As interest rates have risen over the last 2 years, it can harm the returns that you can generate in a rental property as mortgage costs increase. So what we wanted to do was go a little bit ahead of the curve and say, well, as interest rates begin to fall, we can see a circumstance where money starts flowing back into real estate as profits start to rise because interest rates drop. So we've increased your part of the portfolio accordingly. So on a completely separate note, we've also increased your exposure into European markets. Over the last 2 years, we had quite a low exposure into this area, and that's just primarily due to some of the uncertainty that we've seen in that area of the world. War being one of it, and then also stickier inflation data. So inflation has remained higher for longer. Today, though, companies are starting to produce better results, and so we want to make sure that we're giving everyone exposure or more exposure into this area of the markets. So over the last 2 years, we had a fairly strong weighting in the United States, and it has been the best performing region in the world in that time frame. And so what we're going to do is trim off some of those profits and then buy some European companies. Finally, we've made some changes to the tactical part of your portfolio. We've seen some very strong returns in the technology sector over the last 18 months. And one of the main drivers of that return has been a company called NVIDIA. Over the last 18 months, it's returned almost 700%, and it's a position that you own within your portfolio. So we've paired NVIDIA back to its target weight, and this has actually been the third time we've done this in the last 18 months. Because we've wanted to scale back some of the technology exposure that you have in your portfolio, we ended up selling Arista Networks and purchased a company called Arch Capital Group, ticker ACGL. Arch Capital Group operates primarily in North America, but it has expanded into Europe, Asia, and now Australia. It showed really strong financial results when we were looking at the statements over the last number of quarters and has consistently grown, which is something that we're looking for in the tactical part of the portfolio. Arch Capital Group operates in the insurance business, primarily looking at things like professional liability, property, and also mortgage insurance. With the need in North America for homes and new homes to be built, we felt that Arch Capital Group was well positioned to benefit from this. In addition, there's also been an increase in insurance premiums in some of the other coverages that they offer. And so again, it's going to be something that the company overall will benefit from and should allow the company to continue to grow. Lastly, we did switch the TD Science and Tech Fund in your portfolio. This has been a fund that you've owned for a number of years, and we bought the NASDAQ First Trust 100 ETF. Both of these investments are in the tech sector. However, the TD Science and Tech Fund had a very large position in NVIDIA, And we just felt that we wanted to own a technology a technology fund that didn't have as large of a position in any one particular company. So the NASDAQ First Trust 100 ETF actually takes an equal weighting to each individual company that it owns within the ETF. So that's all for now. As always, if you have any questions, feel free to contact us and we'll be happy to help. Otherwise, if we don't hear from you, enjoy your summer. Thank you.